A power of attorney gives you the peace of mind of knowing you've protected yourself and those you love by assigning someone you trust to make key decisions for you when you can't. We don't know if or when that day will come, so the sooner we do it, the better. Completing this important legal document incorrectly can lead to costly delays, and, in worst case scenarios, an uncorrected error can invalidate your power of attorney. At which we'll help you get it right. Our specialist review service puts your power of attorney in the best place to be approved first time, and to work when you need it to. Our specialists will go through it with a fine-tooth comb to make sure it's error-free and legally compliant. Buy today or before the 30th of June to save 30%. And to do that, just head to whichwills.which.co.uk/POA offer. That's whichwills.which.co.uk/POA offer.
When life gives you questions, Which? Get answers.
Welcome to the Which Money Podcast, your weekly hit of money news and personal finance hacks to help make you better off. I'm your host, Lucia Ariano, and here's what's coming up this week.
It's not uncommon for people having to pay several hundreds of pounds more now when remortgaging than when they took out the deal 2 or 5 years ago.
I think it's also an idea of knowing what is going to be affordable to you now versus finding that perfect time. There's never going to be a perfect time.
Inflation has finally hit the Bank of England's target. So could interest rates finally be coming down? Many people are still facing big jumps to their mortgage payments as fixed terms come to an end. So is there any good news on the horizon? And if you're worried about your repayments, what can you do? Well, to help us work out what's going on with mortgages right now and cover so much ground, I'm joined by a team of top experts. Riley Solferini, a mortgage advisor, regularly found giving mortgage tips on TikTok, and Stephen Maunder, a familiar voice for our listeners, a Which Money's mortgage specialist. Welcome both.
Hello, thanks for having me.
So good to have you both on the show. Well, shall we start from the top then? Stephen, can you take this one? Inflation fell to just 2% last week, which is the Bank of England's target. But when they met to discuss interest rates, they held them at 5.25%. What is going on?
Yes, I think people have been waiting for most of this year in hope of a cut to the Bank of England base rate, but it still hasn't arrived, unfortunately. Essentially, what's happened is, as you say, the bank have been trying to get interest rates down to 2%. That's the target, but only just got down there, and there's still a little bit of uncertainty about whether a base rate cut now would be too soon. The last thing the bank want to do is cut the base rate and then inflation starts rising again. They want to get inflation down to 2% sustainably first. And there may also be a factor impacting this, which is the fact the election is just around the corner as well. And obviously, there are dangers that any possible change to the base rate now could be seen as in some way having some kind of political impact or motivation. And that's the last thing they would want to get involved in as well.
It does seem like quite a lot higher though, doesn't it?
Yeah, I think it's the 7th time in a row it's been held at 5.25%. And I think at the start of the year, if anyone wants to go back and hold me to account for my start of year predictions, I think I was saying they would have cut the base rate probably twice by now, and we haven't had any. So it just shows that what tends to happen with the Bank of England is they meet every 8 weeks or so to discuss the base rate, and the cuts tend to happen maybe the meeting also after you think they might happen. They tend to err on the side of caution rather than the side of making a change.
Well, speaking of predictions then, shall we make some more? Hopefully these will be a little bit closer. Do we have any idea when mortgage rates might start to fall?
If you read the news this week, you'll see a couple of lenders have cut their kind of headline rates, but unfortunately, overall rates are stagnating and in some cases still rising slightly. I've been speaking to a couple of brokers in the last 24 hours or so, and I'm very much still of the belief that we may see rates drop slightly between now and the end of the year, possibly in line with, the hopes of 2 base rate cuts, but maybe only 1 now. But we won't see rates start to fall to any kind of significant level until next year, most likely.
And of course, some people have had some really massive jumps in mortgage repayments up until now, myself included. Our old producer, Rob, we've talked about it at length on the show. Can you explain just how big a rise some people are having to cope with? What sort of mortgages are on the market right now compared to before they rocketed?
If you're looking at remortgaging now, you're probably on a 2-year fix. You're looking at somewhere between, I think, about 4.75 and maybe 5.25 in terms of the best deals, and maybe around about 0.5%, just less lower than that for a 5-year fix. But a lot of these people coming on to 4.5%-5% mortgages will have taken out their current deal at 1.5%-2%, which is, it's now more than double that. And the impact of that obviously depends on your specific deal, how much you're borrowing over how long, but it's not uncommon for people having to pay several hundreds of pounds more now when remortgaging than when they took out the deal 2 or 5 years ago. And it's really unfortunate because people come to me, and I'm sure Riley's the same, and they say, like, how can I get around this rate rise? And a lot of things you can do, but ultimately rates are just higher than they were. And that's the sad fact of it, really.
Well, Riley, can we hear a bit more from you on this then? Because I know you're very in touch with your audience. How is it affecting people? Are people putting off making big decisions, for example?
Yeah, it's an interesting one. Statistically, yes, there is a big difference. Personally, I've not really felt it too much, but I know other brokers have in the space. But the government statistics are showing that the monthly transactions of properties that were over 40,000 purchase price prior to the mini budget was about 100,000 to 110,000 per month. And then we all know what happened after the mini budget. Interest rates went mental. And then over that 6-month period after the mini budget, it started to reduce quite a lot, down to 79,000 per month. So it was a good 20% decrease, which is quite drastic. The LNC Remortgage Tracker shows that in September, the average 2-year fix was about 3.6%. And then at the start of October, just 10 days after the mini budget, it increased up to 5.2. And then in November, it was 5.9. So you can imagine that's a massive increase in just 2 months, 2%. That's bigger increases than we'd seen for the past 15 odd years in the sake of 2 months. So it caused a massive change.
Yeah, we did talk about that on length on the show. You know, I was in the midst of it, remortgaging myself. Our producer then, Rob, was as well. It was a very tough time. It still is. But the shock of it, I think, I really felt it personally as well. Literally checking every day, expecting, hoping that rates would not go up, or potentially there might be a lower rate on the cards. And it obviously didn't go that way, did it?
Yeah, absolutely. It was a hope for everyone that it was just going to be a temporary problem, but then it became such a big thing, and people were leaving these low fixes because they weren't sure if it was going to keep going up and up. So they wanted to secure into these, but they didn't know that it was going to just rise to that 5 and a bit percent and just stay there. But nobody really knew what was going to happen. So it definitely has put people off previously, but the rates stabilizing, slightly decreasing from then, has brought people back into it. The average transactions is about 89,000. So 10,000 less than before where we were with good interest rates, but it's definitely coming back with the banks getting security to drop rates slightly again.
So is it time to wait then? Say you're a first-time buyer or you're looking to buy a property. Should you be waiting it out, or should you be getting out there and looking at properties again now if you want to buy?
I think a lot depends on your own sort of personal circumstances, because we've had a market for most of this year now that has been waiting for base rate cuts, waiting for the cost of borrowing to go down. And ultimately, it's a chicken and egg scenario, because obviously you have first-time buyers as a fairly decent sized proportion of the market, but most people who are sellers are buyers too. And if they're not putting their house up for sale, then they're not buying another one, and no one can buy theirs, in very simple terms. So what we're seeing is, despite what some estate agents and popular property portals may be saying, what we're seeing is very few properties really coming onto the market, as Riley touched on previously. But I guess what I would say is that if you have been hanging on for rates to go down, the speed of rate decreases, as we've discussed, is unlikely to be quick. Rate decreases are unlikely to be significant in the short term. So it may be worth you thinking, what am I gaining now by waiting for much longer? And it may be that, particularly if you're a first-time buyer who's already got finance in place, then it may be that you're in a very strong position to negotiate at a time when the market's fairly flat. You may be able to get sellers to reduce their asking price, etc. So I guess what I'm saying is, don't get hung up on this idea that in a couple of months' time, mortgages might be cheap again, because they probably won't be.
One thing I would just like to add to that is that there's a lot of people who are always saying that the house bubble is going to burst and they're expecting house prices to decrease drastically. And whilst we've seen slight decreases over the past 2 years because of interest rates, they've not been so significant to the previous 5 years of increases. Houses increase average like 7 to 10% per year. They have done for a long time. However, you'll have 5 years of 7 to 10% increases, and then you'll see a 5% increase and try and jump at the opportunity. But you could have bought that back when you could have previously. And now that same house is now unaffordable to you. So I think it's also an idea of knowing what is going to be affordable to you now versus finding that perfect time. There's never going to be a perfect time.
After a quick break, we'll be back with your options if you're due to remortgage or, again, you're thinking about buying a new property. And we'll also cover how to get help if you think you're struggling to afford your repayments.
Like listening to podcasts just like this one from the team at Which? Well, we've got some good news. All our podcasts are now available to listen to on YouTube and YouTube Music. So whether you like listening to Get Answers, Which Shorts or Which Money, all episodes can now be listened to directly on YouTube or through the YouTube Music app. To find them, just search for the podcast you'd like to listen to. YouTube's additional functionality also means that you can now read along with subtitles as you listen. Don't panic though, all Which podcasts are still available to listen to elsewhere too. So wherever you listen, we'll see you soon.
Now, just before we jump back into it, I want to remind you about a brand new series we've started here on the Which Money podcast feed. It's called Which Money Shorts, and each fortnight we'll be giving you a taster of some of the brilliant journalism you can find in the Which Money magazine. Our fantastic team of journalists work all year round to bring Which Money subscribers reviews, investigations, and features in the bi-monthly magazine. So every other Monday, we'll be handpicking our favourite pieces and bringing them to life right here on the Which Money podcast feed. The next episode drops on this very feed this coming Monday, the 1st of July. Now, back to mortgages. And we had a lot of news in part one. So what should you be doing if your mortgage deal is coming to an end? The big question I'm sure many of our listeners will have is, how long should you fix your mortgage for? Riley, can you take this one?
It's an interesting one. It's tough to say how long you should be fixing for, because what you should be doing is looking at your personal circumstances and understanding your goals on what you want out of your next mortgage. Whether you like the flexibility to review your circumstances in a short term where a market could potentially be going down, if you have the freedom to change your option, if your life changes, if you plan on having kids in the short term, you don't know if you want to move soon. These are all options that need to be considered when you are going forward with your mortgage options, because if you stick into a longer term, then you might have really high early repayment charges to pay potentially if you do look to leave the mortgage early. But if you're wanting long-term stability where you're not really looking to move, you're going to be happy where you are, you don't really mind where interest rates go, because as long as you can afford them in your head, you're fine to continue paying this amount, then something longer could be an advantage to you because you do have that long-term security. The best way to know what you should be doing is just chatting to an advisor who can recommend what is going to be best for you with your current goals and your future goals in mind as well.
And there are things you can do to make your mortgage a bit less of a shock. If you're in a fortunate position to have savings, how could you use your savings to make your mortgage smaller?
There's a couple different ways you can use your savings. The two main ones are to overpay on your current mortgage, which is where whatever you overpay, which is over your mortgage amount monthly, this goes towards your equity within the house. That's the amount that you actually own itself. So if you overpay by £1,000, you're going to own £1,000 more of the house itself. Now that's going to decrease the amount that you're actually having to borrow against, which in turn will decrease your monthly payments. And another benefit of this is that it could push you into a lower loan to value bracket, which in turn will change your interest rates as of the given time. So it might not change your interest rates back to what they were previously, but it's going to be potentially slightly more competitive than what it is now. So that's one way you can do it.
I'll just stop you there then, because I'm really interested to know. So is it a no-brainer then, overpaying your mortgage payments? Or is there some number crunching that has to be done?
Yeah, I think it, again, depends on what is available to you. Let's say you were one of the lucky ones and took out a 5-year fix at a 2% rate just before everything went to pot. You are now at a point where if you put £100 into your mortgage, you would save £2 worth of interest because it was on a 2% rate. However, if you find a savings account nowadays, which is pretty easy to find them at the 5-6% rate, you're now gaining £5 to £6 by putting that in a savings account instead of saving £2 worth of debt, if that makes sense. There is a bit of number crunching, and it completely depends on person to person and what your attitude towards risk is. That's a really big one. That kind of leads on to my next point as well, which is another really good way to use your savings is through offset mortgages, which in turn is essentially like linking your savings account and your current account towards your mortgage. So if you've got, let's say, £30,000 in a savings account, you can link that to your mortgage, which would decrease your balance of your mortgage that you need to owe by £30,000. So if you add this, it's going to decrease it even further. But if you take away from it, it's going to increase your mortgage balance again. So that can also shift your monthlies quite drastically. The good part about this versus overpayments is that it allows you to keep your cash liquid, so you can move it around. If you do overpayments, it goes straight into the house, and it can be quite difficult to be able to recoup it if needs be.
And can we move on now then to help that's available? Steve, some people understandably will be worried about how expensive their mortgage is. What should you do if you are worried about it at all? Who can you speak to?
Yeah, this is a really big topic at the moment with rates having increased so significantly, and also with the cost of living crisis we've had over the last year or two. The first thing I'd say if you're struggling to pay your mortgage is that you're absolutely not alone. I think the most recent UK finance stats show around about 1% of mortgages are in arrears currently, and it's going up all the time. I think the key thing to say, though, with it is that, and this is maybe a little bit of a misconception that people have, is that your lender does not want to repossess your home. Your lender will take steps and do whatever it can, both within the regulations set out by the Financial Conduct Authority and within its own lending practice to stop that from happening. So just to give a kind of bit of insight into that, I'm just looking at the most recent stats. There's around about just under 100,000 homeowners in arrears of more than 2.5% in the last quarter, but only 870 repossession proceedings were completed. So although figures are going up, people aren't having their homes repossessed to any significant degree. Now, if you are struggling to pay your mortgage, the first thing to do is contact your lender just as soon as possible. If you know you're going to remortgage to a high rate and you're going to struggle to pay it, contact your lender, because there are lots of support options available. Now, the exact options will vary depending on your circumstances, but it could include things like extending the term of your mortgage to reduce your payments, temporarily pausing the payments of the capital balance, so you're only going to pay interest only for some amount of time, or, as we saw during COVID, temporary payment holidays may also be an option in some of the more severe cases where there are examples where, say, for example, the person is suffering a severe short-term impact to their finances, but it will then get back on track in the next 3 to 6 months. But as I say, the FCA have worked really hard with lenders over the last few years to come up with guidelines on what lenders should do when customers are struggling. And although we don't have a huge basis of data on this, the kind of information we're getting is largely lenders have been taking that on board, and they're really trying hard to work with customers to put them at ease over these issues and give them support where they can.
And before we wrap up, it'd be great to chat a little bit more about how the market is looking at the moment. Are there plenty of deals out there? I know we've touched already a little bit on what might be to come, but currently, what's the spread of deals looking like? How competitive is it at the moment?
The current spread of deals, it is quite competitive already. I was at a winter conference not too long ago with the head of markets for HSBC, who showed that on some of their rates, they were only making a margin of about 0.02 to 0.08%. So they were really willing to essentially make nothing to secure business and make it as competitive as possible to bring people back into the market. Now, That was 6 to 9 months ago, and things could have changed, but a lot of lenders do generally follow suit with each other. As the rate cuts come down, they're obviously wanting to be at the top to be able to bring these clients in and make the interest off of them. So being competitive is always going to be at the forefront of all lenders' minds. Currently, there's thousands of deals available, and they've come back since COVID originally hit and the mini budget as well. A lot of deals were pulled very quickly post the mini budget. HSBC, again, as a talking point, I remember getting emails from them maybe once every day, having them changing their rates. I think there's a lot of deals that are competitive in the market, and it's looking good currently.
And obviously, we mentioned earlier on about rates not changing potentially ahead of the general election, but possibly that might be one reason. But what might happen after the general election? Do we think that could have an effect on rates at all?
I think that's the big unknown at the moment. I do think sometimes the impact of things like general elections on the market and on mortgages, etc., may be overplayed. But we are in a situation at the moment where we're only, a week away from the election, and it's highly likely that when we have a government in place, something will be around the corner, particularly for first-time buyers. It's difficult to speculate on exactly what that will be right now, but I think housing will be a key area. I think we've heard reports and rumours of things like mortgage guarantee schemes, Help to Buy schemes, stamp duty, holidays and cuts being extended, etc., kind of across the parties. But I think that the best you can hope for in the short term is that a government being in place after the election, ideally with a majority, will result in greater stability and give confidence to people to go out and buy and sell, lenders to lend, etc. And beyond that, it's all about what policies come about, what we see from the manifestos that comes into reality. It's really far too early to say what the longer term impact will be.
For our listeners, are there any final tips, any bits of advice that you'd like to leave us with today?
I think whether you're in a position to purchase or remortgage, or you're just starting, I think you should be reaching out to someone who knows exactly what they are doing so that you can understand what is going to be the best course of action for you. There's nothing really worse than thinking you're on the right path and then you've done a year's worth of saving or anything like this, and then you realize it's not the path that you needed to go down. So I think just chatting to someone will allow you to plan for your deposits, get a realistic house price. It sets your expectations straight from the off, and you've got a clear path on where you want to be and how you're going to get there.
Yeah, I would echo Riley's sentiment there. I think speaking to a mortgage broker is really important. I think especially at a time when lenders are repricing, deals are coming onto the market and disappearing. We've got 50 plus lenders offering mortgages. Whether you're a first time buyer, whether you're remortgaging, don't just go to your bank because you know them and you've dealt with them for a long time, because chances are they're probably not going to give you the best rate that's available in the overall market. So yeah, please do take expert advice.
Just a little quick one to follow up on that really fast. I think if you're coming to the end of your fixed rate as well, you should be looking 6 months before your fixed rate ends, because mortgage offers generally allow you a 6-month period to hold this offer. If you got a 5% rate and rates increased to 5.5%, happy days, because you've now got a rate from a time where it was 5% instead of having to now be forced onto this higher rate when you could have got something cheaper. And if the rates do go down, then you can proceed to follow those rates down as well. So there's no reason to not look early and to make sure everything is in place, because if you wait too long, your options are cut very quickly, and then you can be left on a much worse situation than you needed to be.
I learnt the hard way with that. So that's a really brilliant tip to end on today. Thank you both so much for joining us.
Really appreciate it. Thanks for having me.
Well, a huge thank you again to Riley and Stephen for coming on the show today, and to you for listening to this week's episode of the Which Money podcast. If you enjoyed today's show, please do hit subscribe to make sure you catch our new episodes as soon as they drop. For daily money news and advice, you can find us on social media at Which Money and online at which.co.uk/money. We also have a free money newsletter, which is delivered to your inbox every Monday. To sign up, visit which.co.uk/money newsletter. This episode of the Which Money podcast was written by me, Lucia Ariano, produced by James Rowe, and produced and edited by Adrian Bradley.
Want to stay ahead of fraudsters and across the latest scams? At Which, we helped prevent an estimated £1.8 million in scam losses last year thanks to our Scam Alert newsletter. And each week we provide more information on the latest scam activity, helping protect you, your family and your friends. Stay in the know and avoid falling victim to scammers by joining over 450,000 people already signed up to our free Which Scam Alerts. To join them, head to which.co.uk/scamalert and sign up today.